Hi, I'm Alan House. I'm a senior analyst here at Value Line. I'm joined today by two other senior analysts, Nathaniel Ekman and Charles Moran. Today, we're going to provide an update on the economy and stock market. We will then recommend our one stock to buy right now, and finally, answer your questions. Please note that this presentation will be available on our website. That's www.valueline.com and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining for the first time, I want to provide a brief overview of who we are here at Value Line. We are a New York headquartered corporation that has been providing investment research for more than 90 years. Our flagship product is the Value Line Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Value Line's research department, which is comprised of nearly 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including all the equities under our coverage. Value Line does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer or our different tiers of subscriptions, that information can be found at valueline.com or you can call 1-800-VALUE-LINE. Now let's discuss the economy and the stock market. This content was prepared by Value Line's economic staff. The Federal Reserve appears to be taking a wait-and-see approach with regard to monetary policy. True, the central bank will end its bond selling program on December 1st, which will loosen the monetary reins by keeping more liquidity in the financial system. However, another interest rate cut next month is now far less certain after a few Fed officials expressed hesitation to reduce rates given the still stubborn inflation backdrop. The Fed's more measured approach also may be due to the lack of available inflation and labor market data. In fact, due to the recently ended government shutdown, no employment report for October will be released. That said, the releases are expected to pick up in the coming weeks ahead of the next Federal Open Market Committee, FOMC meeting, which could quickly change the lead bank's perspective. The U.S. economy will be a focus of the Fed. That is because with ongoing concerns about inflation in the labor market, policymakers want to avoid causing a notable slowing in growth and a period of stagflation commencing. Stagflation, as seen stateside in the 1970s and for decades more recently in Japan, is hard to solve as economic tools have opposing effects. Third quarter earnings season, though, signaled continued growth stateside. As of press time, more than 90% of the S&P 500 companies had reported results, with an overwhelming majority exceeding revenue and profit prognostications. Earnings growth was averaging around 13%, which would mark the fourth consecutive quarter of double-digit gains. The U.S. consumer is proving resilient. Sentiment has weakened in recent months on tariff and inflation worries. However, shoppers, albeit more price sensitive, are still spending at a healthy clip. According to the National Retail Federation, spending in November and December is forecasted to exceed $1 trillion this year. Given that personal consumption accounts for 2/3 of the gross domestic product, the economy still appears to be on solid footing. In conclusion, volatility in the equity market has picked up recently with concerns about exorbitant artificial intelligence spending supported by increasing use of debt financing and a less accommodative Federal Reserve spooking investors. Given this backdrop and the market's heightened valuation, we believe a portfolio led by stocks of companies with a history of steady earnings and cash flow growth and with a history of steady earnings and cash flow growth and cash equivalent securities is warranted. On that note, Value Line provides a great deal of information and analysis to help our subscribers. We know that most of our print and digital subscribers depend on our weekly stock reports, time-tested ranking systems, and other valuable services. To that end, we're constantly working to improve our offerings in order to ensure the best possible experience for our subscribers. Our latest innovation is that in that regard is the Value Line digital booklet, which offers our subscribers a powerful new tool to see the information we provide digitally in a faithful reproduction of its original printed context. To access the digital report, first head to the dashboard, where I am already located. Then click on the investment survey under traditional online access. From there, the digital booklets for both current and back issues can be accessed. Once the digital booklet is opened, navigation is as easy as flipping the page or alternatively jumping to a specific bookmark using the sidebar, which is conveniently organized by industry. On top of our regular reports, Value Line provides additional daily content on markets and individual companies that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company press releases, news, stories, trade periodicals, and other sources for data information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desk, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and shareholders. This content is posted throughout the day on our website. Once again, that's www.valueline.com. I will now show you how to access these reports. First, head to the dashboard. Under the quick links, click on Supplementary Reports. As you can see, the research department has been busy publishing our updated thoughts on the stocks that we track. We strongly suggest that subscribers visit this page often. Some individual companies incurred a lot of debt or sold stock to build their cash reserve over the past few years, especially those dealing with sharply reduced demand for their offerings and supply chain problems, among other issues. Due to this changing structure of the company balance sheet, Value Line has been reviewing and updating our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our selection and opinion newsletter. For those of you that don't know, financial strength, along with price stability, another proprietary Value Line measure, are the two key metrics that are used to calculate a stock safety rank, which is an important tool to measure risk. When considering a new stock to invest in, we strongly suggest you utilize financial strength and safety in your decision-making process. For more information about our proprietary ranks and ratings, Value Line provides a user guide that can be accessed via the investment education section of our website. Now let's move on to the one stock to buy right now. For this, let's go to the screener. Value Line subscribers have access to 15% preset screens and 50 fields. I should also mention that another 100 or so fields are available, but it requires a higher level of subscription. If this interests you, please call 1-800-VALUE LINE. As noted in our economic commentary, although the tariff situation appears to be improving, there remains a great deal of uncertainty. Accordingly, today we're going to be looking for stable, financially strong companies that are well positioned to outperform the market at large. We're going to start by applying our time-tested safety ranks. Safety measures the total risk of a stock and is arranged on an easy-to-understand scale from 1 highest to 5, with 1 including the most conservative issues. I want to highlight the fact that while stocks ranked favorably for safety have in the past held up far better in the broader market during corrections and downturns, they also meaningfully participate in up markets. For more information, I encourage you to peruse our ranking system guide, which is available free of charge from within the investment education section of our website. Today, we're going to focus on stocks with a safety rank of 1. By applying the first criteria, we've trimmed our list down to 95 stocks. Next, we're going to filter for timeliness. The timeless rank is used to predict the relative 6 to 12-month performance of stocks in the value line universe. The format is an easy-to-understand scale from 1 to 5, with those ranked 1 likely being the best performing issues on a relative basis. Most often, buyers will want to avoid stocks ranked 4 or 5, while those ranked 1 or 2 are considered above average. Today, we're looking for stocks ranked 2 or better. Applying that filter, we are down to 23 stocks. We also want a stock that will generate solid returns over the longer term. To screen for those, we'll be looking for stocks with 3 to 5 year total return potential of at least 10%. After applying that filter, we are down to we're down to 15 stocks. Next, we're going to look at 18-month appreciation potential of 15% or better. After performing this screen, we have our final 8 stocks. As you can see, they are American Waterworks. Excuse me. Nick, could you please make that a little bit bigger if possible? Thank you so much. American States Water, Cognizant Technology Solutions, Amdocs, Illinois Toolworks, Marsh & McLennan, Microsoft, T-Mobile, and Walmart. You can make a case for any of our remaining candidates, which span a number of different industries, and investors interested in adding new positions should consider them. However, only one can be today's one stock to buy right now. And after consulting with a number of our senior analysts, we prefer and recommend Walmart, ticker WMT. Before I click on Walmart, please note that screens can be saved and revisited by utilizing the Create Save Screen button on the top. Now let's click on the last full page report on Walmart. Walmart owns the largest retail chain, operating about 3,560 supercenters. As can be seen in the array on the value line page, the company has enjoyed healthy sales and earnings advances in recent years. We look for that trend to continue, given the company's immense size and strong competitive position. There are a few notable growth drivers in the year ahead. Walmart's e-commerce business has become profitable owing to online sales growth and higher margins from its online website. The company also continues to expand its advertising arm, which is a high margin sales stream. Walmart makes money on advertising through its advertising platform by selling ad space on its e-commerce sites and its physical stores, to brands that may want to reach its massive customer base. Walmart is also investing in automation in its supply chain and AI-driven upgrades to its e-commerce platforms to increase efficiency and reduce expenses. What's more, it should continue to benefit from the expansion of its Walmart Plus membership program, which provides recurring revenue and promotes loyalty. International markets such as India and Latin America are also showing strong growth. Hence, the stock is a good choice in our view, given the current economic landscape. Walmart is a low-price leader in consumer goods, making it the go-to option for many shoppers in both good and more difficult economic times. It also has garnered some market share from higher-income households, particularly during inflationary periods. The company has been a consistent dividend payer, which helps boost shareholder returns and offers a measure of protection in the event of a stock market decline. In summary, Walmart has above-average earnings growth potential thanks to its multiple revenue sources, which should lead to above-average share price gains. It is today's one stock to buy right now. We will now tackle your questions. Please note that we typically can't answer complex questions about specific stocks on the spot. For this, I recommend a review of our latest reports. The first few questions are submitted prior to the presentation. Now I'll hand it off to Nathaniel and Charles. Thank you.
All right. So, we've got a question here. We've got a question here asking about what is the financial strength on the page there. You can see for Walmart, there's a financial strength of A++, which is, a very high grade. So a company's financial strength is a measure of its overall financial health and its ability to withstand economic downturns or adverse conditions. It's a crucial metric for investors. It sort of indicates a company's capacity to meet its obligations, manage debt, continue funding operations without, any excessive risk. So it tells you not exactly the same thing as the safety rank. The safety rank incorporates that information and a few other things, but it is a very useful piece of information to have, especially if risk is a concern.
Thank you, Alan. It's Charlie. I had a few questions submitted to me prior to the presentation by Alan. The first one was, what is Value Line's target price range? When your strategy is long-term growth, your goal is to buy stocks with potentially above-average price appreciation, and our analyst-derived 3 to 5 year price target range is one of your most important tools for identifying these stocks. Target price range is a forecast of where Value Line expects the average price of the stock to be in the next 3 to 5 years. The range is based on our analysts' informed estimate of company earnings during this period, multiplied by the analyst's estimated price-earnings ratio for the same period. The difference between a stock's potential high and low prices depends on the stock's safety rank. Expect a stock with a high safety rank to be more stable and therefore to have a narrower band. A stock with a low safety rank is likely to be more erratic and therefore have a wider range. Because the analyst calculates the target price range using an estimate of future earnings based on information available at the time it is calculated, this measure is very subjective. As company performance changes in the future, the target price range will also be altered. The second question that was submitted is, what is financial strength? That had been, I guess, answered by Nathaniel, but just to corroborate some of the things that he mentioned, it has 5 components, or the key components of financial strength. The first one being balance sheet health, debt levels within this, the amount of debt relative to equity, also known as a debt-to-equity ratio, and the company's ability to service this debt, the interest coverage ratio, are a few metrics that one can use to look at debt levels. The liquidity the availability of liquid assets to meet short-term obligations, often measured by ratios like the current ratio and quick ratio, and asset quality, the quality and valuation of the company's assets, including cash, receivables, and inventory. A second metric would be the operating cash flow and free cash flow. The operating cash flow is the cash generated from the company's core business operations, which is crucial for funding day-to-day operations and reinvestment without needing external financing, while free cash flow is the cash remaining after capital expenditures, indicating how much cash is there for payment of dividends, debt repayment, or reinvestment. Third would be profitability, which is comprised mostly of earnings stability, consistency in generating profits, which reflects the company's ability to maintain earnings over time, and also the return on equity. The ROE is a measure of how effectively the company uses shareholders' equity to generate profits. The fourth consideration would be credit ratings. The ratings are provided by agencies like Moody's, S&P, or Fitch, which assess the likelihood of a company defaulting on its debt. And then lastly, the capital structure itself is the mix of debt and equity financing used by the company, with a stronger financial structure typically having a lower proportion of debt. As it pertains to the financial strength, just to reiterate, a company with strong financial strength is generally more resilient to economic downturns, can take advantage of growth opportunities, and is less likely to face financial distress. Conversely, a company with weak financial strength might struggle during tough economic times and could be at risk of bankruptcy. The third question was regarding Walmart, and mentioned that Walmart reported earnings and its share price is up today. Do you have any insight into what is driving that? Yes, Walmart's stock price is higher today because the company reported third quarter earnings and sales that surpassed expectations of analysts, along with a raised full-year forecast. The strong results were driven by a 6% rise in revenue to $179.5 billion and a 4.5% increase in same-store sales in the U.S., exceeding forecasts on both counts. Strong U.S. same-store sales also occurred. The same-store sales rose 4.5%, higher than the expected 4%, while foot traffic increased by 1.8%. In terms of the full-year guidance increase, they raised their forecast for the full fiscal year, now expecting net sales to increase in the range of 4.8 to 5.1%, up from a previous estimate of 3.75% to 4.75%. In addition, they are attracting a wider customer base. The company reported strength across several different income levels, including higher income households, indicating its ability to appeal to value-seeking customers in the current economic environment. And they also stated that they will be making a move in terms of stock exchange listing. The company announced it's transferring its listing to the NASDAQ stock market from the New York Stock Exchange on December 9th, in a move that is seen by some analysts as a reflection of its transformation into an e-commerce leader. I would also say that it is holding up in a relatively poor market that initially rose on NVIDIA's better than expected results last night and has now subsequently fallen to session lows during the session, yet Walmart has maintained its strength throughout the session. So I think that that is encouraging and speaks to its defensive nature. I don't see any other questions. Nate, do you see any other things of note?
Yeah, I do. Just really quickly, we have some questions just about our criteria for the stock screen. So that was 10% or better was what we were looking for the annual total return. and 15% or better was what we were looking for the 18-month appreciation for the screen. I know we went through those a little bit fast, and I did see we had some questions from people who wanted to note those down.